let's take the opportunity to dive into the specifics of depreciation. For appraisal purposes, depreciation is defined as a loss in value from any cause. It's measured by estimating the difference between the current replacement of reproduction costs new and the estimated value of the property as of the date of value. To contrast with depreciation, there are times when appreciation can happen, usually as a result of supply constraints or additional demand for certain features. Any appreciation may offset other decreases in value due to depreciation. Supply and demand imbalances, which create appreciation, are not incredibly common, but appraisers need to be on the lookout for the possibility. Depreciation includes all the influences that reduce the value of the property below the cost new. Let's go through some examples under the three main causes: physical deterioration, functional obsolescence, and external obsolescence. We'll start with physical deterioration. It can be caused by wear and tear from regular usage, negligent care, which we usually describe with a nicer term, deferred maintenance, damage that occurs by dry rot, termites, etc., or damage caused by severe changes in temperature. Functional obsolescence can happen as a result of bad architectural design and style, a lack of modern facilities, out-of-date systems servicing the structure, changes in styles of construction over time, as well as construction methods and materials which become obsolete as time passes. Changes in taste also drive functional obsolescence. For example, desiring a master bath or more garage space. And the last example is super adequacies and improvements. These can be a pool or excessive additions where the actual cost is more than a buyer is willing to pay for those features. External obsolescence, those factors that affect the value of the property, which are environmental and economic and are outside the property itself. Some of these influences are an unexpected improvement, those improvements that are not typical for the neighborhood, zoning or legislative restrictions, factors imposed by the government, detrimental influence of supply and demand, for example, a large development creating an oversupply of a similar property. And lastly, being in proximity to undesirable influences. For example, busy streets, the freeway, airport flight patterns, a waste treatment facility, or high voltage power lines. The first two major categories, physical deterioration and functional obsolescence, are viewed as being part of the property and therefore can be either curable or incurable. The last category, external obsolescence, is nearly always incurable. Now, I need to address the differences between the understanding of depreciation for different parties. That is, that the appraiser themselves has one definition of depreciation, which often is different from an owner will have when it relates to their taxes. You might consider the appraiser's view as actual depreciation, and for the owner's tax purposes, book depreciation. Since we spent time covering how an appraiser will deal with depreciation, let's first jump over and cover book depreciation. As it relates to taxes, book depreciation is a math calculation where you would steadily reduce the value of the property from the owner's original purchase price or cost basis. This allows the owner to recover the costs of the investment over the life of the improvements. I need to be careful not to say the property as a whole is recovered over the useful life, but the improvements only. The depreciation, in this case, increases annually and is used as an income tax deduction. The deduction is used to reduce the property owner's gross income. Because of the depreciation, it is possible for an owner to have a negative gross income, at least as far as tax reporting is concerned. It's important to remember that depreciation is not a dollar figure that's paid out during the course of the year. Rather, it's a reduction in the value of the asset over time as a result of expected physical degradation and therefore usefulness. Because of the potential for loss on paper, That can be a strong motivating factor to purchase or exchange an income property since it reduces an owner's tax burden. There are three important characteristics of book depreciation. One, it is an allowable deduction from the cost for accounting for income tax purposes. Two, it's determined by the owner's policy, which has to meet IRS requirements. And three, it's deducted from the owner's original, or we might say historical cost. The book value is the current value for accounting purposes defined as the original cost plus capital improvements, and then subtracting for the accumulated depreciation. After adjusting the value to the improvements, we have to add it back to the value of the land. Let's talk about actual depreciation. The book depreciation isn't necessarily relevant to the appraiser because they consider actual depreciation as opposed to book depreciation. The appraiser, importantly, will not look at the owner's original cost, but the cost new on the date of value and then reducing by an estimated of the actual accrued depreciation. Because the accountants and the appraisers are using different rates of depreciation and they use it for different purposes, they typically differ quite a bit. One of the main driving forces is the accountant is going to be restricted by the accounting policies and conventions, and the appraiser isn't restricted by these. As a general policy for us as real estate brokers, it's important to understand there's major differences in the book value and actual depreciation. If we are valuing property using the cost approach, we need to ensure that we use the appraiser's method in order to get an appropriate value for the improvements.